never had a problem generating gross. There's a lot of guys that don't have a problem controlling expenses. And there's a lot of guys that don't have a problem generating gross. And I sat down with Bill, and I can sincerely tell you that it was a life-changing experience for me when he started telling me, Helmy, you're doing a great job, but this is what needs to happen here, there, and you'll make a lot of money. And that was a life-changing experience because we went from producing a lot of income and not keeping much on the bottom line to producing a lot of income. Buddy, it was 40, 45% net to gross, and having a return on investment on your money for 15%, which is the average deal at 2 and 3%. And we'll talk about all those numbers and not get ahead of ourselves.
But I do this a lot with dealers one-on-one, and it teaches a dealer, it takes some of the mystery out of what goes on in the office. Once you turn the deal in, once you've done all the things these guys are talking about and turned it in, then what happens? And is it right? And how can you check up on them? That's the big thing, and particularly the dealers, because if your office manager has all the control and you don't know how to go back behind her, you're vulnerable. And I've had, over the years, worked with some dealers who, for one reason or another, have gone out of business, either intentionally or unintentionally. We do a fair amount of work with dealers who've been out of trust. We've been put in situations where the bank's sitting there holding all the keys, and we get a phone call, can you come up and see if we can do anything? And it is not a fun experience. It's not a fun experience for the dealer. It's extremely, extremely stressful. People have literally died going through the process because it's so stressful. So once all the dust settles, we sat down and we've talked, and we've had, for either legal reasons or tax reasons or whatever, had to go back through the books together and go through the numbers. And I've had a couple of them say to me after the fact, listen, if I'd have known this before, I'd have made a whole lot of decisions differently, number one. And number two, I'd still be in business today. So what I'm going to try to show you is what all these, when somebody's talking about source 10, source 20, source 56, all of this kind of stuff, when they're talking about schedules, when they're talking about the general ledger, when they're talking about the financial statement, what is all that stuff? I mean, unless you took a lot of accounting in college, and even if you did, a lot of it's not terribly applicable to dealerships because they teach you all about manufacturing companies. They don't teach you about a business that's got 5 independent businesses running inside of one store. So I've got a tremendous amount of respect to anybody who can do that, to run, because you've got your service department, your parts department, your new car, your used cars, and you've got F&I all going on, plus a body shop. It's a complicated business. So the accounting has to be complicated to keep up with that, all of those different departments. Okay, by design it has to. Otherwise, you've got one big huge number, and you can't break it down into what's going on in the individual departments, and then you can't hold people accountable, and they get away with whatever they want to get away with. So I'm going to go pretty quickly through this, but if you got questions, stop me. Bill's going to jump in here as we get to pieces that cover his presentation too, and so that's kind of how we're going to approach this. So what we're going to do is we're going to talk about, now that you've made your money, how do you keep it? One of the dealers that I started working with several years ago taught me the 3 rules in business. He said, Greg, do you know what they are? And I said, no, what's rule number 1? He said, collect the money. He said, you know what rule number 2 is? Collect the money. What's rule number 3? Collect the money. You don't collect the money, you're out of business. I don't care what money we're talking about, whether it's a holdback, whether it's a warranty, whether it's a contract, whether it's a vehicle receivable, whether it's a down payment, whether it's an incentive. If you don't collect all the money on a deal, you didn't make what you thought you made on the deal. Okay? If there's a $2,000 incentive and the office never applies for it, or it doesn't get applied for under the right code, you didn't make $2,000. If it's a $2,000 incentive, you made 0 on a $2,000 deal. It doesn't show up till after the fact. It doesn't show up until the salesman's been paid, the sales manager's been paid, the general manager's been paid. It doesn't show up until after the fact. Everybody's got their commission except the dealer. He didn't make any money because nobody bothered to follow up and apply for that incentive. We have literally found in some cases where a contract was done for a customer. It was a $25,000 contract. The deal had to get recontracted because they had run it through the wrong bank, wrong lender's forms. They recontracted it. The girl in the office said, I've already processed that deal, stuck the contract in the file, stuck it in the drawer. There's $25,000 sitting in the drawer. $25,000. Okay? It was an honest mistake, but they didn't collect the money. So even if they made $2,500 gross on that deal, Where were they? They were upside down, 25,000 minus 2,500, 22,500 they gave away. The customer's driving around in a free car. They're making no payments. 6-8 months go by before this all came to the surface. What are you going to do? I mean, how are you going to unwind this problem? You got to get the customer back in. You got to try to get the contract cashed. You got to try to get them a payment book. Customer's not calling up. They got a free car. They wonder what the heck's going on. But they're not going to say anything, most of them. So this is, how can you keep up with that? Well, in that particular dealership's case, what was going on is the office manager would prepare a heat sheet. You guys may get these. They're manually done, all the contracts. If they're manually done, then they're telling you what they want you to know about, okay? In other words, it's not necessarily what all of the deals are, and once these things get old, everybody wants to ignore them. Everybody wants to forget about them, pretend they don't exist. And so they quit putting them on the heat sheet at some point. What's your cutoff level? Is it $500? Is it $100? Is it $50? Is it $1,000? Is it $2,000 that goes on that heat sheet? If somebody doesn't bring in, if they've got a $1,000 down payment, they only bring you one $500 check and promise to bring you the next one next week, are you putting that other $500 on that heat sheet every day or not? Sometimes you do, sometimes you don't. If they've asked 4 times for the customer to come in, at what point do they quit writing it on the sheet? Well, it's still on your books. It's a loss. It's coming out of your gross on the deal. Are you going to get your commission back from your salesman or not? I don't know. Every dealership operates differently. A really tight office wouldn't, number one, wouldn't let it happen in the first place, would have a real computer printout from the computer that's given to the sales manager, to the dealer, to general manager to follow up on, and everything on that sheet cleared. But if the schedules get messed up, if they get a little bit out of control, it is hard to get them back into control, number one. Number two, the credibility goes away. That's why you start doing these manual lists. And I'll go into dealerships that are spending $8,000, $10,000, $12,000 a month on computer systems, and then with ADP and Reynolds, and that's what these things cost. I don't care what they tell you. That's what these things cost, just about. And they're spending all this money on this extremely sophisticated computer system, and then they're handwriting the heat sheet. That's ridiculous. Right?
True.
So what we're going to try to do is try to help you know whether your office is getting the job done or not. That's what Bill and my objective is today. Not to teach you accounting, not to teach you debits and credits, although we're going to say a little bit about debits and credits. Don't fall asleep. Debits are on the left, credits are on the right. But what we're going to try to do is here I've got this drill down. If you're a dealer, you probably get a financial statement once a month, right? At least. The question is, can you go from the financial statement to a source document? A source document is a check, it's a bill of sale, it's an RO, it's a parts ticket, it's a journal entry. Can you make that trail? Very few dealers, I submit, can do that. Very few that I work with. You agree?
Yes, sir. Absolutely.
Why should you need to know that? Well, because if you know how to go from one to the other or vice versa, then you can tell what's going on in your store. Okay, again, I don't want to teach you accounting necessarily, but if you understand how this is all fitting together, you can manage it. You can't manage what you don't know. So the way it works is the financial statement is the end result. You've got a check that you write. It gets posted by the journal, the cash disbursements journal, which feeds into a schedule of all the checks for the month, which feeds into the general ledger, which is a complete transaction history for the month, which feeds into the financial statement. Now, is everybody asleep? Okay. Now, what I'm going to do is I'm going to show you a financial statement. This is a Hyundai statement. It's pretty similar to Suzuki. Most of the manufacturers are, and I apologize for the clarity of this, but this is a typical dealership financial statement anymore. Over here, we've got assets, and Bill, jump in here anywhere you want. Over here, we've got liabilities, and down in the bottom section you can't see on the screen is equity. Equity is what the dealer has got invested in the store. Okay? Right here is working capital, and there's supposed to be a guide number in here. Up here, we're going to focus on 3 accounts today in the interest of time because we only got a little over an hour to do all of this. We're going to look at contracts in transit, we're going to look at receivables, and we're going to look at lien payoffs, the 3 items I've circled. On this financial statement, this column here is the account number. This column here is also an account number. And what we're going to show you next is what makes up these numbers. It's nice, and I bet you a lot of dealers never even look at this page of the financial statements.
Let me jump in here if I can, if you don't mind. I have a dealer that bought a store a few years ago, and when he went in the store, he based his decision based on the fact that what the expenses were going to be in that store when he bought it. The first month they got the statement, it was $70,000 higher than what the performance said. That store the previous year had lost $1 million. So now he's looking at a store that has the potential of losing $2 million. He said he was about to have a heart attack when he did that. He called in 2 accountants to come in. They looked at the books and all that, and they said that everything checked out fine. And see, that's what, you know what I'm saying when I'm saying this. I'm not being critical when I talk about accounting. They look at things to make sure that they balance. The debits and the credits balance. They balanced. He said, well, something's not right. And I'm getting ahead of myself because where I was going to be in this, but it's okay because it ties in great here with this, because what he did is I want to sit down and I want to do what what Greg's talking about here is doing a line-by-line expense review. So what you do is you break out every item that goes into that line on the first statement the first page of the statement. And he sat down with his business manager for, he said, about 2 to 3 hours every day, and in a month's time, they had gone through every account in that dealership. And they had found almost $70,000. They didn't cut anybody's pay. They didn't let anybody go. They didn't fire anybody. None of that. What it was just a lot of duplicate things that were being done. Entries that weren't being properly accounted for in that, and they found all that. So what I'm saying for you right now, in your future, and I tell this to all of our 20 groups, and Helmy, you've heard me say this 100 times. Guys, do a line-by-line expense review every month.
Actually, after the first seminar that we had in August, if you remember, a couple of other dealers chose to take advantage of what you're talking about, where they actually flew me into their dealership. We did that, and then you went back and did that, and one of our good friends ended up saving close to $35,000 a month and didn't cut a single human being's pay.
Exactly.
Yeah.
It's, what we call that in 20 group is this is called expense creep. And it just happens. I mean, and people just don't pay attention. And as a manager, or particularly as a dealer, when it's your money, nobody's going to pay attention to your money like you are, because it's your money. I'm not saying when you go back into your dealerships and that is to do this every month. What I'm saying is do a portion of this every month, so that you stay on top of it, so it's constantly in the hopper. So you're staying on top of this. Because, as an example, Helmy, Helmy was a founding member, one of the founding members of one of our 20 groups. And I think the first 2 or 3 years that we had that group, we spent, oh, by the way, would you all turn to page 183 in the book, please? It's under bonus materials 1, whatever that's supposed to mean.
All the way to the end of the book, guys.
Page 183?
Under the bonus material.
And to that point, the last question there, it says, what's more important, gross generation or expense control? Almy? Okay.
Who wants to answer that, guys? Ask the question one more time, please.
What's more important, gross generation or expense control?
Expense control.
I think expense control. How about you?
I'd say equal.
Equal?
I'd say equal.
We're going to ask the man.
Yeah, they're both important. They're both equally important. The one goes hand in hand with the other.
If you had to pick one.
I'm an expense control guy,
You're
but
an expense control guy.
Expense control. Same. Expense control.
Joe?
Expense control.
This is tough. I mean, it's not easy. But let me ask you this question, because Helmy knows when we did that 20 group, we spent at least the first 2 years of meetings talking about what, Helmy?
Gross.
Gross. You don't have gross. There ain't no sense talking about expenses. Right?
I say you have to have something to count, right?
Right. If I've got $200,000 in expenses and $150,000 in gross, how long am I going to stay in business? See, that's the problem. You start making an assumption that your business is going to be profitable. First thing you got to do is generate, because I used to tell Helmy and the guys in that group, let's not worry about expense control right now. What we want to worry about is generating gross. So we should spend all of our time talking about the things we're not talking about today. Was how to generate leads into your business, which Helmy and his crew will do with you guys. How to generate sales, what's the best form of advertising, how do you track that advertising? What advertising you find that works, what doesn't work, how do you track it? 800 numbers, call sources, call leads, all that stuff. That's what we talked about in those meetings, was how to generate gross. I said, because once we start getting to you guys, because they were all pretty much, everybody was kind of pretty wet behind the ears, you know, in that, and they really didn't know a lot of things about the business. A lot of them had been sales managers, really didn't understand anything other than let's just drive traffic to the store and let's concentrate on that and get you guys to be successful. Long and the short of it is that last year we have about 150 20 groups, and we ranked them all, conventional 20 groups like that. And we ranked them all based on the only pure number we know, which is a percent of return on sales. And last year, for a period of time, that was a Suzuki group, guys. The number one performing group out of all of our 20 groups was a Lexus group. Big surprise, right? The number two best performing group out of 150 20 groups was the Suzuki group that he was in. So I'm telling you, it can happen. But you've got to have gross before you can worry about expenses.
I'm a big fan of controlling expenses, obviously, as an accountant, but, you know, you can cut the frivolous stuff, is what Bill's talking about, the duplicate things. You've got 2 uniform contracts, combine them into one, negotiate a better deal, things like that. But you can only cut so far before you start cutting out bone. And that's what he's talking about with the grosses. So both are important. You cannot have one without the other, as several of you said. And I'm not here to talk about only expenses today. I'm going to leave the gross side of it to the expert.